there are some very basic mistakes that a lot of new angels make. First is they don't diversify enough, and the second is they don't understand the time horizon. So often, people they get some money, maybe they had an exit or sold some stock or who knows what. They get some money, they decide, oh, I want to go angel invest, and they meet with some companies. And most of these startups that out there are very exciting. They have really impressive founders. They're great at selling their story. And a lot of new angels get really excited about one or two and end up investing a lot of money in them. They say, oh, okay, I've got maybe they're going to invest $1 million. And they say, oh, I'm going to do it over the next few years. And the first year they see one that they just fall in love with, and they put maybe 100K into it. And then invariably a year later, the company comes back and says, maybe they're doing well, maybe they're not, but the investor's like, well, this is like my favorite company. They put another 100K. And maybe there's a pay to play round 2 years later. It basically, they can very quickly end up putting half their money into this one company. Most of these companies don't work out. Like half lose your money either entirely or most. A handful will return maybe 1 or 2 times your money after 8 to 10 years. And it's only like 1 out of 10 companies that will give you a 10x or more. And it's really like maybe 1 out of 100 that will really return 100x or more than that. And so odds are if you put a third or half your stash into one company, you're going to lose your money. Or maybe you'll get it back, but it's going to take 8 to 10 years. And that leads me to the next part. Most people think they're going to get lucky and they're going to get their money back in 3 years or 5 years, or they're going to sell their position in secondary. Who knows what? No, like my first investment that I did in 2012, Chubby's, I think it was 10 or 11 years before I got an 11x return in cash. The second one that I did in 2013 is still not liquid. It looks great on paper. I think it's also about 10x now. But it's now, so 2013, yeah. So it's now been 11 years. And I think it's still going to be probably another 5 years before they ultimately exit. So I'm probably going to end up holding that position for 15 years or something like that. It really takes a very long time. And so the main advice and then the other thing is, as you gain experience in angel investing and build a track record, one, you start to have better deal flow. As you become known as an investor, more people approach you, more people refer you opportunities. And two, you get better judgment. And so if you blow your stash in too few companies and too quickly, you're probably not going to do that well because your deal flow wasn't that good. And you're going to be out of your money in a short amount of time. And it's going to take 8, 10, maybe even 15 years till you get the money back from those initial investments. And so my advice, putting this all together, is go slow. Write much smaller checks than you think you need to. In fact, write the smallest checks you can. Do 1K or 5K if you can into the first companies you see for the first few years. Develop that experience. Establish yourself as an angel investor that other people refer deals to. I would bet over time you'll still do those small checks because you'll realize, hey, like it's a very small amount of these companies that return everything, and it takes a long time, so you need to preserve your capital. I guess for me, this was a mistake I made. I started out writing like 25K checks, and very quickly I realized I was pacing too quickly. The liquidity wasn't going to come for a long time. And now, even though I've done really well, I have a ton of capital on paper. Most of my checks are small. Most of my investments are like 5K, and in many cases 1K. If I'm investing through a syndicate. And for the really good companies, that's enough. Like the really successful outcomes will return 1,000. And so, yeah, I realize I'm talking too much, but the message I'd want to get across to all new angel investors is go slow, diversify a lot, build a portfolio of at least 50 and preferably at least 100 companies, and expect that it's going to take 10 years to even get your money back one.
Peter, welcome. How are you?
Doing well, thanks, Barak. It's great to be here. Thank you for having me.
You have been investing many years. What inspired you to start investing in startups and become an angel investor and also VC?
Yeah, happy to share. I'll give you kind of the even further background, which leads into that. So my professional background is almost all in startups. First as an operator, actually, and then later as an investor. I went through 2 startup companies early in my career. I was very early in both of them. So the first, I was the first employee and first engineer they hired. And the second one, I was the founder CEO. The first one, I got very lucky with. We developed the product, launched it, raised a lot of money, grew really fast. And they ended up going public in 2016 and are valued at about 3, maybe 4 billion now. The company's called iRhythm. It's a medical device company. They make devices for diagnosing cardiac arrhythmias, which are electrical problems with your heart. So anyway, I got very lucky there. After that, I went to try founding my own company. And that one, we had a good start. We raised venture capital, built a team, developed the product, but just everything that could have gone wrong went wrong. I made a ton of mistakes as a first-time CEO. But I also learned a lot. And the funny thing is, even though it was like the hardest experience of my life going through that failed startup, I actually learned way more from that one than I did from the successful one. So even though it's really tough, I'm grateful I had both of those experiences. And it really shaped a lot of it shaped how I think about investing, and actually really helps me provide a lot of valuable perspectives to the founders that we invest in. So went through those two companies, hopped around a little bit after that, did a brief stint doing corporate venture at GE Ventures, which doesn't exist anymore, but it was General Electric's corporate venture arm. And my investing journey started with a tiny personal angel investment in a friend's company. He was my roommate when I lived in San Francisco. Basically, I put in a very small check, and they ended up doing really well. It was a company called Chubby's Shorts. They ended up merging and went public a few years ago. But so anyway, I did that investment in 2012. They got off to a good start. I liked how it felt, decided to do another investment the next year. Also in a friend's company, that one got off to a good start as well. The year after that, I ended up doing 8 investments. And it was actually at the same time that I was working in corporate venture capital, and very quickly realized I not only did not like corporate venture capital, but I realized I actually don't even think it makes sense. Like, I don't think it should exist as a type of VC. The incentives are very misaligned. And anyway, that's a story for another day. But while I was doing that, I hated that. I was loving the angel investing, decided to leave corporate venture, set out on my own and try out angel investing full time. Ended up doing that for about 5 years by myself professionally, made about 150 personal angel investments all over the place. Ended up getting very, very lucky, in large part because I just got very curious about crypto in 2015, which turned out to be pretty early. Developed a lot of conviction, allocated big amount of my personal funds heavily into that space, and ended up with just a very high multiple fund in a short amount of time that was liquid as well, which meant financially I could keep investing. But more interestingly, it led to friends starting to ask if they could invest with me. So that led me to creating Unpopular Ventures in 2019 as an extension of my personal investing. Started as just a syndicate on AngelList, where I invited friends to follow me on there. It wasn't a fund. I would invite these friends. I would find deals that I was going to invest in, but then I'd also write a memo about why I thought it was a good investment. I'd share it with these friends that were followers. They could choose which deals to invest with me in, and for how much. And I'd collect all the money into individual SPVs and write the companies bigger checks than I could have on my own. And it really worked, and it grew very quickly. So we're now about 5 years into this. We're no longer just a syndicate. A lot of our LPs said, here, just take my money in a fund, please invest me in everything. We've now invested about $68 million into 400 plus companies. And we've gotten very lucky too. We've invested in several unicorns. The $68 million we've invested on paper is now worth about $182 million. And yeah, we're also one of the biggest syndicates on AngelList now. So we have about 4,700 LPs who follow us, and then 100 something in our fund as well. Anyway, it's really worked. And I'm realizing that's probably more than you were looking for in your question, but that's kind of the arc of my journey.
That's a great story. So you have worked with different cultures, 400 startups. I mean, probably lots of countries. What are some biggest cultural differences you have observed working with founders in regions like the Middle East, Africa, Latin America, comparing to Silicon Valley?
Sure. So to be honest, I think I will probably have a disappointing answer to your question. So if we were really going into these geographies, trying to really learn about them ourselves, find locals with budding businesses to invest in and invest like that, then I think we'd see a lot more in the way of cultural differences. The approach that we've taken is, yes, we're very global, but the types of founders that we generally invest in, most of them they have kind of they know how businesses operate. Most of these companies that we're investing in are actually U.S. Delaware C corps. It's safer legally for us to invest in those when the business is based overseas. An example of that, I mean, this might be an interesting answer for you. So we're invested in a company in Colombia. It's called PCAP. They basically do, it's like kind of like Uber, but on motorcycles in Colombia and other countries in Latin too. For whatever reason, the Colombian government a few years ago decided they didn't like that business. They decided to go in and raid the offices and shut the whole thing down. And luckily, the company wasn't incorporated in Colombia. It's a U.S. Delaware C corp with a Colombian subsidiary. And so, although the Colombian government capriciously came in and just like took that out, none of the money was in there. None of the corporate entity shareholders, right? Like the company was not in Colombia. So they, like a month later, they created a new subsidiary again in Colombia, moved off somewhere else, brought the whole team back in, and they just kept going. And so because it was the company is effectively a U.S. company that operates in Colombia, we weren't impacted, or they were not impacted by some of these. I don't know if it's kind of cultural, it's kind of government incompetence. I don't know, but yeah, we weren't affected by anything that's unique to Colombia in that case.
What do you think are some of the secret sauces or unfair advantages that Silicon Valley mindset founders?
Sure. So I think it's not so much. Well, there may be some mindset. I think there are a lot of kind of just process things. You know, network is a big thing. Knowing a lot of experienced engineers, other skills needed in these startups. I think I'll come at it from a different angle. So I'm a big believer. This is probably an unpopular opinion, but I really believe that people who found really huge and exceptional companies that end up being worth billions or tens of billions or hundreds of billions of dollars, when they do that, it's not the first time they did something exceptional. Great founders always have a track record of success before they go and do their big company. And the way we invest, we usually look for some of those signals, like kind of a track record of success that makes them likely to go and be successful with whatever they do. And usually people that are passionate about tech, building a big tech company, they want to go and learn everything there is to learn about it. So they go work for another tech startup, or maybe they tried something else and done pretty well with that. And in that process, learned and demonstrated kind of their capability. And then they go and do their big one. And so it's not so much that I think that, maybe they're learning something from Silicon Valley or tech, but it's more about credentialing in a sense, in that these founders usually do want to go and learn about that stuff and prove themselves in that context, build a network that will then serve them well and help them build that big company. And the thing is, it's like building a company, any kind of really successful tech company, it's an exercise in network effects. Not network effects in the way that social media has or something like that, but in that to build a company, you have to somehow raise the money, you have to recruit the people, and then you have to build the product, sell it, and then go raise more money and recruit more people and build and sell. And it's really hard to do all those things. So like, if you don't have the money, you can't recruit the people. If you can't recruit the people, you can't build the product. If you don't have any product, you can't raise the money. And so somehow you have to break all that. And VC want to fund people that they believe are very likely to be successful. So it's easier to raise money if you have that track record. People also want to join you if they think you're very likely to succeed. So you'll recruit better people if you have that track record, that resume, kind of all that experience. And that makes it easier to build the product. So that whole flywheel, and these things all feed on each other. So once you get the money, then you can hire better people. And once you get the good people, then you can build this thing. And once you build something awesome and start selling it, then you can raise the money. And so that whole flywheel is much easier if the founder is somebody that all those people, the investors, the employees, and also the customer, like the customers want to know if they can trust you. They don't want to, if it's business software, they don't want to like sign up and take a risk on you if they're not sure if you're going to succeed. So the people that go and build these companies that are really successful usually have something about them that leads all these people to be drawn to them. And all that doesn't usually happen if it's the first time they're ever doing something in tech. If that makes sense.
It's on your experience. What are some of the less known realities or untold truths about how VCs operate?
VCs are just people, and different people are different. So some VCs operate one way, others operate in other ways. There's some types of VCs that write big checks and they only make one investment a year. Like actually most Series A VCs, like a Sequoia or an Andreessen Horowitz, each partner in one of those firms makes 1 to 2 investments per year at Series A. Maybe they'll dabble in a few more seed investments, but they meet a ton of companies, spend a lot of time thinking, and then they make one investment, and that's got to be their one thing that they did this year, and they get very involved with that company. And That's one way that kind of those traditional VCs operate. There are also VCs that take smaller positions and invest more quickly and maybe are not quite as selective. They don't need 100 companies to invest in one. We've taken an approach like that. We are very selective in who we actually meet with. We look at a lot of decks. We read about a lot of opportunities. But if we end up taking a meeting with the company, at least for me, my partner, Thibaut, might meet with more. But at least for me, if I take a meeting with the company, it's about 50-50 that I'm going to invest. But we make a lot of investments. So we're pacing at about 160 investments a year. Most of them are pretty small checks. A lot of our investments are 25 to 50K. Some are bigger. I did a couple $500,000 investments in the last few months, but most of them are small and we pace quickly. So that's different from that other style I mentioned. Some VCs are very involved with companies, some are less. Some are easy to work with, some are not. I think we're pretty easy to work with. But I don't think you can really paint all of VC with a kind of a broad brush.
How do you track 400 companies? What is your involvement after investing?
Check later. So I'm a big believer that the best founders, the ones that are going to go on and be really successful, don't need help. Like, it's a funny thing. Throughout my career as first an angel investor and now I guess a VC, it's funny. I found a lot of opportunities where I've thought, wow, like this is a cool idea, but the founder needs help. But hey, if I invest, I will be able to help them be successful because of something that I know or some skill I have or connections I have. Those never work out, unfortunately. And in contrast, most of our best investments were ones where from the get-go, we said, wow, this founder seems like he's going to be really successful with or without us. And we beg him to let us invest. And luckily he let us, or she let us. And yeah, like all our best investments, the founders kind of took the money, ran, and went on to be super successful. It didn't even need us. And so, yeah, we try to invest in a lot of those where it's like, yeah, we feel lucky to be investors. We're grateful to the founders for letting us invest. Maybe we can help here and there. Maybe we'll do an intro or two, but they're going to be successful with or without us. And they don't really want our help. And we're very happy to just stand back and let them go and be successful. We're just happy to be along.
What are your thoughts on having investment committees versus individual partners making the investment decisions? Which approach do you believe is more effective, and what does your selection process look like?
Sure. I think investment committees are really dumb, to be honest. I know that a lot of them exist, so apologies if I offend anyone. So there are a couple of things about VC. So first, the good deals move really fast. Second, the best investments are usually pretty non-consensus in the beginning. Most people think that they are bad investments. I mean, there are endless stories about this, like how Airbnb had to pitch something like 60 or 80. I don't remember the exact number, but they had to pitch a ton of VCs and everyone thought it was a terrible idea. Obviously went on to be very successful. Google tried to sell themselves for $1 million to Yahoo, and Yahoo said no. Or maybe it might have actually been Excite. Anyway, they tried to sell themselves for $1 million in return their investors' money, and they couldn't do it. So many others. All the really successful investments were unpopular in the beginning. And so one, I guess going back to the first point, they move really fast. So if you have to go through an arduous process, it takes a lot of time. You're not going to get to invest in the best companies. You're going to have this adverse selection bias where the companies that are still around for you to get through your whole investment committee process and invest are not going to be the very best ones. I actually, early in my angel journey, I joined two angel groups in South Florida. And they had a very arduous process where first a bunch of people had to get together, do diligence on it. They all had to then vote on if they were going to submit to the investment committee. Investment committee would then meet like once a month and decide if they're going to approve it or not. And this group would take sometimes 6 months to decide whether or not to do an investment. And so not only did they miss the good investments to begin with, but then everyone in South Florida knew that they'd take 6 months to decide. So every good company would be like, why would I go even talk to them? They would go to the serious angel investors that could decide quickly. And so, I don't know how they've done since I was with them, but at least during the time that I was there, their investment returns were pretty terrible. There's more to it than that, but I do really think that, yeah, if you move slow and you have a reputation for doing slow, you're not going to get in on the best companies. It's a great example of adverse selection. And then, yeah, if you want to have everybody vote, the majority of the people are not going to think the best investments are good. And so at least the way that we operate in our tiny firm, it's me and one other GP, my partner, Thibaut Reichelt. He and I both have complete autonomy. We often talk about the investments afterwards and decide if we're going to invest more or what. But we both make our own investment decisions. We're ultra fast. I think and I think he too, basically we do like one meeting, we spend a lot of time on the materials, we do a little due diligence, but we decide within a day or two, and wire the money right after that. So we're ultra fast, and we make tons of mistakes. I've made tons of terrible investments, and I'm sure he has too. But we've also both gotten in on really, really good ones, ones that were fast and hot, or also ones that were very unpopular. And because of our autonomy and our ability to do these unpopular investments, we've ended up with great returns. So it's like, I think in VC, you have to be okay with making mistakes. A big part of this is losing money half the time, sometimes even 90% of the time. But you also got to make sure you're getting in on these extreme outliers that then pay for everything else many times over. And you can only do that. I don't think you can do those either fast moving or very unpopular non-consensus investments if you have to push it through an investment committee.
Which frequent 3 questions do you ask in these meetings? And one to today, what is your decision process look like? Do you, there are very few data in early stage startups. Do you trust your gut?
Yeah, well, so, the first thing is, the question I ask all of them is to tell me your story and, where do you come from? How do you decide that this is the thing that you want to dedicate a huge chunk of your life to? I really believe that to build a very successful company, it takes at least 10 years and probably longer. And so why did you decide that this is the thing that you're going to spend 10 years on? And then I usually go from there. For certain companies, there's usually with each company, the kind of the crux of it is different. So I usually try to focus in on what I think is likely to be the biggest risk or the biggest barrier to success or something. And that changes for each company. But one of the main things I look for, especially at the beginning, is storytelling and selling ability. So it's not so much that I'm looking to be convinced myself. I'm looking to see, do I believe this person is going to be able to sell all the other people they need to build the village around them, to make it really successful? So are they going to be able to sell other investors, both at this time and in all the subsequent rounds of funding they're going to have to raise? Do I believe they're going to be able to sell to customers? Do I believe they're going to be able to recruit top talent? Will really good people want to work for them? And a lot of that just comes out in their story about who they are and why they're doing this. Pretty simple.
What are the red flags in these meetings?
Red flags certainly exist. But let me see if I can think of a few off the top of my head. The main reason I often say no is just I'm not really. Sorry, let me just close this. I'm just not sure if they're going to be able to recruit everybody they need to be successful. They're not going to be able to raise the money from other investors. They're not going to be able to recruit the people they need. They're not going to be able to sell the customers. But some of the other red flags are, how committed are they? We are really trying to invest in things that are going to compound over a long period of time and become super valuable. I really believe that all the gains in startup investing come from compound interest, or not really interest, but compounding growth. And so, a lot of VCs actually look to exit early. They ask, okay, what's the exit strategy? We're going to sell this to for 10x in 5 years or something like that. And no, we are actually looking to invest in, minimum 100x net return potential outcomes. And really, we prefer 1,000x potential. And you can't grow 1,000x in 2 years or 5 years. It takes at least 10 and probably more like 20. And I really want to invest in these things where I can just be an investor in this founder and never sell and let them grow their company 2x a year for a long time. One of my favorite pieces of math is that if you can simply double in value each year for 10 years in a row, that's 1,000x, 1,024x to be exact. And so, 2x in year one, okay, that's, okay, it's nice to double your money, but it's not that much. But if you can simply double in value every year for 10 years in a row, you get 1,000x. That turns a $10,000 investment into 10 million, or 100,000 into 100 million. That's big, and that's really what we're going for.
How do you think about the follow-on investing in your top performers? Do you typically invest multiple times?
Yeah, we follow on in about 10 or 15% of our companies. It's a mix of both the ones that we have a lot of conviction in and think are executing really well. And this is based on updates and just kind of how we see the founders conducting themselves and the progress that they're making. And then also in some of our companies, they just get so hot, and in many cases, we don't necessarily have pro rata. And in one of our companies, it's called Zepto in India, we managed to get a small check into their very first round on a $13 million valuation. And then they just got really hot ever after that, and the VCs boxed us out, and we were never able to invest again. They're worth like 1.4 billion now, and probably even more than that now. But we ended up with great return. We're happy to be in it. But the company and the other VCs just never let us invest again. And we would have liked to, but we were able to.
Is that common, or especially the first time? I mean, first investors, first checks, or angel investors are overcome with the VCs coming after rounds. Even sometimes you don't have the financial reports access.
Oh yeah, that's true as well. Yeah, I mean, there's a mix of situations. Like yeah, we don't have a ton of money, so yeah, we have another portfolio. I can't say which one it is, but it's in Africa. We were very early in that one as well. They're now raising at a unicorn valuation. It's a $150 to $200 million round. And we actually do have pro rata. We're going to invest, but we don't get much info. We don't get financials or anything like that. And it makes sense. Like they don't need our money. Like the max we will probably invest is $500,000, maybe $1 million if we're lucky. They don't care about that relative to the 150 or 200 million they're raising. And they're probably worried about competitors. They don't want their financial info leaking all over the place. So yeah, we have situations like that where we can invest, but we don't get all the info, and that makes sense. The company just doesn't even need our money, even if they will let us invest.
Does it make a difficulty in secondary shares selling timing, because you wanted to sell probably your shares in the long midterm, but you will not have a financial reports or anything about the company, and the buyer would ask you some reports because they wanted to see how the company works. So does it make a difficulty, these kinds of situations in secondary sales?
Well, so we don't really sell very often. We haven't sold any of our positions to date, even though we've been offered to buy positions in several of our companies. We do have one position in a company where they've gotten very valuable. This one investment, we did it initially in 2019 and followed on after that, but just our 2019 investment is worth 2 times all the money we invested that year. And so it's a very big, a lot of our LPs are asking for liquidity in these times. As a result, we're considering that, hey, if we could sell just half of this one position, we would return our entire fund or the vintage, as we call it, 1x, and still keep half and keep all the other portfolios for the upside. So anyway, we are in a situation where we are considering selling. And no, we're not going to be getting financial information for any buyers. There are a lot of buyers out there that are doing their own due diligence and reading online or getting access to some insider info one way or another. And we receive bids frequently from other investors at various prices for this and other positions. And for us, it's a question of if we take it or leave it. And right now in that specific company, the bids are a little bit below where we would be willing to part with the shares. But if they come up a little bit more, I think we say yes, and it'll just happen. We don't have to get that inside financial info to provide to the buyer.
Is there a pattern with the failing startups in your portfolio? Did you check a pattern?
No, I mean, I think failure is the norm, actually. Like building a successful startup is super hard. By definition, a startup is a company that probably won't work out. And most won't. I mean, we really hope that they all become very successful, but the ones that are rare. They're outliers. They're exceptional in some way. I do think, although I've been doing this startup investing for about 12 years now, I don't think I've really gotten significantly better at it. Maybe I'm a little bit better, but even investing now, it's always still super messy. Companies that I think are like slam dunks are going to do really well have something go wrong and end up being zeros, and then other ones that feel very risky. I mean, that is actually something that seems to always tie together with our best investments. They always feel really, really risky at the time. I can think through like all 3 of our unicorns. I was able to articulate a case where it's like, hey, if we're lucky, this one could be very successful. Here's how, but it's super early or it's super risky, or they're going after a market that has problems. Probably won't work, but hey, because there's this 10% chance that it'll work, and that would lead to 100x or 1000x. Even if it's 90% chance we lose our money, it's a good bet. And so we do it. And those are generally the types of profiles that end up being very successful. It's ones where we acknowledge that they probably won't work, and then somehow they do. And I've yet to see a case where like I was so certain that something was a great investment, and I was like, oh, we're totally not going to lose money on this. I've never had one of those be very successful. So it's just a game of building a portfolio, making a lot of bets. It's going to be messy. Most of them won't work out. We won't be able to predict. And you just have to be okay with that. I think that's one of the hardest things about VC. You just got to be comfortable that it's really messy. You're wrong a lot. And if you build the portfolio well and you're a little bit lucky, then you end up doing really well.
Do you have early signs that the startup may not be working out?
No. So actually, it's funny. In the last couple of weeks, we've had multiple companies that I would label phoenixes, in that my partner and I were pretty sure that they were not going to work, or maybe if we weren't sure that they weren't going to work, like there was founder drama or market turmoil. Like we have one investment in commercial real estate where like commercial real estate market has been really in the dumps, and I was like, oh, like mentally I was already like, oh yeah, this probably won't work out, and then somehow the founder pulled something off, and all of a sudden they're raising a big up round. And with another one recently also, there was a huge founder breakup. One founder threatened to sue the others, and like it was very messy, but it ended up splitting into two companies. One of them I think has effectively shut down. The other one has now become like one of the hottest seed stage companies in Germany. They're raising a big up round, very successful now. And so we have these cases where it's like maybe we kind of lose faith for a little while. It's not that we write it off fully, but we're just like, oh, okay, this is probably going to be one that doesn't work out. And then repeatedly, over and over again, we are surprised that somehow these great founders rise from the ashes and take their companies to success. So I think whatever you see early on, I'm sure a lot of these still won't work out, but great founders will very often surprise you. They'll kind of build these phoenixes where they rise from the ashes, succeed despite all kinds of setbacks.
How do you balance the deploying small checks and writing larger checks in selecting the startups? Because you told that $25,000 to $500,000.
Yeah, I mean, there are a few ways I could come at this. So the first is, I think there's a lot of value in being an active investor, somebody who's out there writing a lot of checks and can move quickly. And I think that benefits us because founders know that if they approach us, they're very likely to get money. And that leads to a lot of founders approaching us. If like they know that some VC takes 100 meetings and only writes one check, like it's really hard for them to justify spending that time. But they see, hey, we did 160 investments last year. They see, wow, that's a lot. If I go to Unpopular Ventures, they're probably going to, maybe it's 50-50, or they're likely to get money, especially if they end up meeting with us and spend some time with us. So I think that having that fast deployment, even if a lot of them are smaller checks, is valuable because it leads to better deal flow for us. We like it too because it takes time to get comfortable enough with a founder or founders and company to write that bigger check. If we write a $25K check, we can read their updates, spend more time with them, and a year later write that bigger check. Most of our bigger checks are in cases where maybe we've known the founder for a while or spend more time or know the space. And yeah, we can't always develop that conviction without taking up a lot of the founder's time. So by doing that small check and one that we think is promising and then follow on later, that kind of works well for everybody. They get money up front, and we can kind of spend more time, collect more information to potentially invest more later. And then the other thing is, even if we don't invest more, the returns are still good. So like I mentioned that company in India, Zepto, we only did 25K, but the valuation delta is more than, I think the actual returns now dilution are something like 38x. And the fund that came out of was one of our early, it was our very first quarterly fund. It was pretty small. As a result, that one investment, I think, is 1.5 or coming up on 2 times that entire fund. So even though we only got 25K in, because it was an outlier and it's become worth a lot, it's still worth doing. Sure, we would have liked to invest $500,000, but we're very happy to be in for 25K, and it's already going to return that one fund. So, I don't know. I guess there are many parts of it. We're happy to write these checks. It helps us get more comfortable with opportunities. It leads us to seeing more deal flow, to write the bigger checks later. So anyway, it's messy, but it works for us.
How do you source and make diligence deals in different parts of the world? It should be very difficult because you are investing hundreds of startups every year.
Yeah. Well, so as I mentioned earlier, we do kind of look for certain profiles in the founders that we invest in. We generally only invest if these people have kind of a track record of success in tech, either in the region or maybe they came from a tech company in the Bay Area and went over there. or already have very clear measurable traction that's unusual. So we don't actually do a ton of market diligence. It's much more what we look at is who the founders are, what have they done in the past, how likely are they to succeed in the future, and then if they don't have that, or even if they do, then what have they done already in this company that kind of indicates that they are likely to be successful? Like, were they able to get a product off the ground and sell it with very little investment capital, stuff like that. So I wouldn't say it's super deep. It's kind of surface level things, but we're very selective and looking for kind of these founders and stages that already feel very de-risked.
What major trends are you paying attention to right now in the global startup ecosystem?
Oh, so we really don't invest with trends. So we are unpopular ventures in general. We're trying to invest in kind of the opposite of trends. Certainly AI is hot right now. We've done a couple AI investments here and there where we thought, they're really compelling. But for the most part, I guess the way that I think about this is that VC as an industry really has a herd mentality. Everyone kind of gravitates to one area or another each year to the next. And whatever they're into, they end up putting in a lot of money at very high valuations. And whatever that segment isn't any more likely to produce really good investments than any other. And so we're very frequently thinking in terms of, okay, like, who are the really good founders that are building really compelling businesses, regardless of what the trend or the tech is or the market is? Is this a good person, or are they good people in the founders that have a compelling story about why what they're building could be enormous? Do we think that they're going to recruit all the people around them they need to be successful, both the team members, the further capital, customers? And that's it. And we don't care where it is. We don't care what industry it's in, what sort of trend it's part of. We just try to think, I guess, independently about the founders and are they building something big.
What are the emerging startup hubs around the world?
I don't really think like that either. I mean, there's always this debate. Oh, is Silicon Valley the best place to build a startup? And certainly it is. That seems like where most successful startups are. Maybe Miami is coming up as well. But the thing is, like, I think there are really good people everywhere. They have unique insights about all kinds of different markets. And I think there are customers all around the world looking for better solutions. And then also, like, a lot of companies we're invested in have kind of remote teams where we're there too. They're just trying to get the best talent around them. It doesn't really matter where they are. And we have all these tools and capabilities to work with people no matter where they are. My partner, Thibaut, is in Dubai. And we work great together. As I mentioned, my family and I have been digital nomads for the last 3.5 years. We basically live in Airbnbs and travel around the world. And it, in my opinion, has had no impact on my ability to find great investments and make them and be helpful to the companies. And so, for us, I guess I would say we are a remote team. We're very small. We invest in talented founders that are able to build great teams, regardless of if they're in person or remote. And we just care that they're serving customers and a market that's compelling, regardless of where it is. And I don't really think in terms of startup hubs or where the company is that much.
You have lots of LPs. How do you manage these LPs and communicate your strategy and quarterly reports? This should be also very difficult.
Well, it's not. I mean, it depends on how you want to do it. Certainly, there are VCs that raise from 10 or 20 LPs, and they develop really deep relationships with all of them, and they meet with them frequently on a one-on-one basis. And you can do that if you're small. We're not small, so I actually we actually do frequently have LPs reach out and ask to meet with us, and I usually decline those unless they're a very significant LP. It's just if I took meetings with all of our 4,700 LPs, like, well, I wouldn't be able to, but even if I did it with a fraction of them, I wouldn't have time to make investments. So the way we've approached it is we do a quarterly LP update that we actually post publicly. Given that there are so many, even if we did it privately, I think there would be leaks. In fact, in the past, when we tried to share private information, there have been leaks. So as a result, we try to construct our LP updates in a way that they convey all the relevant information. We even post our returns. We even allow them to kind of go through the portfolio companies, but they're de-identified. So it's not company specific. So we're not sharing confidential information about companies. But we share a lot of detail in these public reports that we share with LPs, and then we actually post it publicly because, as I said, we think there are going to be leaks anyway. So we put it out there from the get-go. And then I also do a quarterly office hours with our LPs where I say, hey, I can't meet with you all one-on-one, but I certainly want to be available. So I will be available at this time once a quarter, and whoever wants to call in and do a group Zoom call and ask me any questions or chat about anything, I'm available for that. And that's basically it. And it works. I mean, we're still really small. Like, I don't know if this approach will scale to turn this into $1 billion fund, but we've invested 68 million, raising and investing somewhere between 12 and 18 million a year, which is, it's pretty good. It's big enough for us right now, and it seems to work with this big LP base.
What advice would you have for new angels, not VCs, just getting started today?
Sure. Yeah, so there are some very basic mistakes that a lot of new angels make. First is they don't diversify enough, and the second is they don't understand the time horizon. So often, people, they get some money, maybe they had an exit or sold some stock or who knows what. They get some money, they decide, oh, I want to go angel invest, and they meet with some companies. And most of these startups that out there are very exciting. They have really impressive founders. They're great at selling their story. And a lot of new angels get really excited about one or two and end up investing a lot of money in them. They say, oh, okay, maybe they're going to invest $1 million. And they say, oh, I'm going to do it over the next few years. And the first year they see one that they just fall in love with, and they put maybe 100K into it. And then invariably a year later, the company comes back and says, maybe they're doing well, maybe they're not, but the investor's like, well, this is like my favorite company. They put another 100K. And maybe there's a pay to play round 2 years later. It basically, they can very quickly end up putting half their money into this one company. Most of these companies don't work out. Like half lose your money either entirely or most. A handful will return maybe 1 or 2 times your money after 8 to 10 years. And it's only like 1 out of 10 companies that will give you a 10x or more. And it's really like maybe 1 out of 100 that will really return 100x or more than that. And so odds are, if you put a third or half your stash into one company, you're going to lose your money. Or maybe you'll get it back, but it's going to take 8 to 10 years. And that leads me to the next part. Most people think they're going to get lucky and they're going to get their money back in 3 years or 5 years, or they're going to sell their position in secondary. Who knows what? No, like my first investment that I did in 2012, Chubby's, I think it was 10 or 11 years before I got an 11x return in cash. The second one that I did in 2013 is still not liquid. It looks great on paper. I think it's also about 10x now. But it's now, so 2013, yeah. So it's now been 11 years. And I think it's still going to be probably another 5 years before they ultimately exit. So I'm probably going to end up holding that position for 15 years or something like that. It really takes a very long time. And so the main advice and then the other thing is, as you gain experience in angel investing and build a track record, one, you start to have better deal flow. As you become known as an investor, more people approach you, more people refer you opportunities. And two, you get better judgment. And so if you blow your stash in too few companies and too quickly, you're probably not going to do that well because your deal flow wasn't that good. And you're going to be out of your money in a short amount of time. And it's going to take 8, 10, maybe even 15 years till you get the money back from those initial investments. And so my advice, putting this all together, is go slow. Write much smaller checks than you think you need to. In fact, write the smallest checks you can. Do 1K or 5K if you can into the first companies you see for the first few years. Develop that experience. Establish yourself as an angel investor that other people refer deals to. I would bet over time you'll still do those small checks because you'll realize, hey, like it's a very small amount of these companies that return everything, and it takes a long time, so you need to preserve your capital. I guess for me, this was a mistake I made. I started out writing like 25K checks, and very quickly I realized I was pacing too quickly. The liquidity wasn't going to come for a long time. And now, even though I've done really well, I have a ton of capital on paper. Most of my checks are small. Most of my investments are like 5K, and in many cases 1K. If I'm investing through a syndicate. And for the really good companies, that's enough. Like the really successful outcomes will return 1,000. And so, yeah, I realize I'm talking too much, but the message I'd want to get across to all new angel investors is go slow, diversify a lot, build a portfolio of at least 50 and preferably at least 100 companies, and expect that it's going to take 10 years to even get your money back one.
And if you go back and give advice to younger yourself, what should it be?
Yeah, I mean, yeah, start angel investing early, small amounts, as early as you can, and just get out there and start learning. It's such a good experience. You learn a lot. You get exposed to so many interesting people and cool ideas. And I really think that angel investing is one of the most rewarding things you can do. You're literally investing in people that are building the future, and you get to be a tiny part of that. So I think this is a great thing to do.
Peter, thank you very much. It was
Thank you,
great
Barack.
to have you on a podcast and lots of learnings and insights.
Likewise, Barack. It was great to be here. Thank you for having me.